Okay, looks like we have a lot of people in the room right now. I'll get started. I'll talk a little slowly to allow some more people to join. But welcome to our AAII Journal Ask Me Anything session. Today I'm going to preview the September AAII Journal. I have with me a special guest, my colleague Derek Hageman. Derek, many of you all know, he's the editor of our dividend investing newsletter. Also one of our analysts, writes for the journal. We also jokingly call him our YouTube star. And he's a resident Minnesota Twins fan. Derek, thanks for joining us.
Hey, happy to be here, Charles. Thanks for the introduction and thanks for bringing up my first place Twins. Always excited. I usually have my hat in the background, but I unfortunately forgot it today.
That's okay, but I think the World Series is probably going to go to the team that plays the most games at the rate we're going.
You might be right about that.
Or at least the one that can fill a roster. But so the reason why Derek is joining us, Derek actually has the cover article in this month's AAII Journal. It's about the Meb Faber screen, and I'm actually going to call Derek's article up so we can walk you through it and talk to you a little bit about it. So Derek, I will turn over the conversation to you.
Okay, thanks, Charles. Yeah, I'm excited to be here today. Excited to write AAII's latest screen. Like Charles mentioned, is a screen based off the methodology and strategy from Meb Faber. There is a preview on your screen. It's called Screening on Faber's Unique Approach to Yield Investing. And as a passionate dividend investor, I'm always looking out for something related to dividends. And the idea for this screen came up probably a few months ago. As you know, it's a very collaborative effort at AAII, and I think it was John Bajkowski, our president, who brought it up one day. He presented the book. It's actually, I'll show it here. It's a thin book. It's called Shareholder Yield, again by Meb Faber. He goes by Meb Faber, and he said, "Hey, you should take a look in here. There might be an interesting concept here on using shareholder yield." So I read the book. It's a quick read, and that's what we developed over the next coming months. And so I'm just going to talk about the article in general, give you a preview, scroll through the different paragraphs, and then obviously when you get a copy of it, you can take more time to hopefully read through it. So I just want to start off by mentioning who Meb Faber is. You may recognize the name, but he's actually the co-founder and chief investment officer at Cambria Investment Management. He manages Cambria's ETFs and separate account funds. He's a prolific writer. He's written several books, and he does actually manage a couple funds based on this strategy. So based on his writings, there's one called the Cambria Shareholder Yield. It's ticker SYLD. He also has one called the Cambria Foreign Shareholder Yield. So looking at more foreign holdings, that's FYLD. And then he also has an emerging market fund that's based on shareholder yield called Cambria Emerging Market Shareholder Yield, ticker EYLD. And there is, I just want to mention, and I don't know if it's just serendipity, but actually Meb Faber, he has a weekly podcast, and his podcast last week, he was talking specifically about the Cambria shareholder yield, and you can find that on the Meb Faber podcast site. And I think there'll be some show notes going out so we can have all this information for you. But he spent 20 minutes talking about the strategy and some of the performance metrics for his fund. Our fund is not exact, doesn't have all the exact variables and metrics that Meb Faber uses, but we try to capture the main ones. So let me just walk through the article. So I'm starting on page 7. And again, I mentioned that it's based on information taken from Faber's book, Shareholder Yield. And so really, in a nutshell, the approach, it seeks companies that pay dividends. That's what originally caught my interest. But it also looks at companies' share repurchases and then the pay down of debt. And so together, the summation of these 3 variables is what Faber calls shareholder yield. And really, it tries to capture and measure a firm's commitment to shareholder-friendly practices. So if we go, again, sticking on page 1, talk about developing the approach. So it screens for firms in the universe of stocks with positive yields and positive yields across dividends and buybacks. We thought that would be a reasonable place to start for a strategy for tracking down high shareholder yield companies. Next, we looked at a few quality and leverage characteristics to try to exclude any risky stocks. And then lastly, we used a valuation factor. We looked at the price to free cash flow per share metric, and also looking at companies in the top quintile of shareholder yield to really screen for stocks trading at attractive relative valuations. So another thing we did is we required positive free cash flow per share, which reduced the number of top shareholder yielding stocks. And then as an additional measure to avoid value traps, financial leverage metrics were examined to position the Faber approach to identify really the strongest shareholder yield stocks. And one of the filtering criteria, and actually the one we started with, was to look at the broad universe of stocks, and we were looking for companies with a minimum market capitalization, so shares outstanding times price per share. We were looking for a minimum market capitalization of $200 million for the last reported fiscal quarter, and we really did this to help us ensure a minimum level of trading liquidity. So as we scroll down to the next page, Charles, we do show a table, a figure 1 with cumulative returns. And what we do with all these screens, and in this case, John Bykowski, our president, he conducted a back testing. He did annual back testing on the criteria that we laid out for this screen. And as you can see here, going back to our database starts in 1998. So looking back to 1998 through year-to-date 2020, you can see that based on the criteria we used, the Spirit of Faber shareholder yield strategy, it outperformed the S&P 500. And I think it was on an annualized basis, the Faber screen returned 7.6%. That was the average annual return, versus 4.6% over that same period for the S&P 500. One thing, Faber, he's definitely not shy to build off other people's strategies and philosophies. So a lot of his book, it built on prior research from Wesley Gray and Jack Vogel. They wrote a piece called "Enhancing the Investment Performance of Yield-Based Strategies," and he also built on the prior research of James O'Shaughnessy, "What Works on Wall Street." Let's see. So one of the things. So setting up the screening criteria, dividend yield and growth. So we looked for dividend yield. Dividend yield measures dividend payments relative to share price, and dividends and their reinvestments. We thought this is a important characteristic because dividends and their reinvestments, they've historically provided higher cumulative returns with lower levels of volatility versus non-dividend paying stocks, and this was over the long term. So again, dividend yield, it's calculated by dividing the annual indicated annual dividend by current share price. And the indicated annual dividend, it's the anticipated cash dividend payment over the next year. and it really is it's the percentage rate of return paid on a stock in dividends. And a high dividend yield, it indicates a low price compared to the stock's indicated dividend, meaning that investors pay less per dollar of dividend. And so another common trait for financial strength over time is looking at a long period of uninterrupted dividends. So the Faber-inspired methodology, it looks for companies that both currently pay a dividend, of course, and possess a recent positive trend in dividend growth. So one of the criterions that we specified was positive dividend yield for the last fiscal quarter. And then the next filter required that the compound annual growth rate in dividends per share over a 3-year period, it had to be greater than 3%. So moving on next to buyback yield, and really that measures repurchases. So the AAII Faber approach requires a positive buyback yield filter for the most recent fiscal quarter, because they're in all the research that Faber used, again, building off Gray and Vogel and O'Shaughnessy, was that there's sufficient evidence that shares of companies that are aggressively repurchased, they have better returns over time. And since share repurchases reduce the number of shares outstanding, they increase the earnings, cash flow, and equity attributable to each of the remaining shares, and it really elevates the market value of those shares. Again, that's with all else being equal. And while there are a couple of ways to calculate the buyback yield, the easiest way is to look at the change in the number of outstanding shares. So a stock's buyback yield, it's determined by comparing the average shares outstanding for one fiscal period against the average shares outstanding for another fiscal period. And Charles, if we just move to the next page, another thing we did is we measured an ability of a company to meet its obligation. So the risk with high levels of debt is that a company will not generate enough cash flow to cover the interest payments during challenging times. It's obviously what we've seen over the last few months, so definitely an important factor. So analyzing a company's interest coverage ratio, it's one of the tools investors can use to determine a company's ability to pay its obligations and evaluate the safety of a dividend. So the larger and more stable the ratio, the lower the risk of the company defaulting. And to measure financial strength, a positive interest coverage ratio for the last 12 months, it's required for our screen, and the interest coverage ratio must be greater than or equal to its industry median over the same period. And just to get into what the ratio actually is, the ratio is most commonly calculated by dividing a company's earnings before interest and taxes, a company's EBIT, dividing that by its interest expenses for the same period. And another thing we looked at to further test financial strength of the firm, we looked at interest coverage ratio for the end of the last fiscal year. We required that to be greater than or equal to 0, and also to be greater than or equal to the industry median over the same period. And another thing, so obviously debt is an important factor in Faber shareholder yield. So another component of shareholder yield is the debt paydown yield. So while leverage screens, they don't typically tend to turn up promising investments. What they do, however, is they are helpful in highlighting troubled firms. So we want to avoid those troubled firms that have a high debt level and aren't able to pay their obligations. So as another measure of financial strength, the AAII Faber screen, it seeks companies with stable or decreasing levels of long-term debt. And reducing the net amount of debt on a company's books, it not only reduces interest costs, which is important, but it also increases shareholder claims on future cash flows and assets. And moving on, so there's a section called generating positive free cash flow. So we had a filter requiring positive free cash flow per share for the last 12 months. It's specified as a measure highlighting the effective management of overall company operations. And really this measure attempts to capture whether the passing companies generate enough cash to of course, pay dividends, repurchase shares, and pay down debt. And companies that generate sufficient free cash flow, they can expand during periods of economic expansion, but as well as cover expenses when sales decline during slowdowns. Charles, if we scroll down to table 2 on the next page, we have some of the companies that we have some of the criteria we have above. So we have the company name and ticker, we have the closing price, and this table was done as of the close on August 14th. We have a yield section. So in this case, shareholder yield is the buyback yield plus the dividend yield. If you take those two columns, so in the first case for Synchrony Financial, it has a buyback yield 14.6%. It has a dividend yield of 3.5%, which gives us a shareholder yield of 18.1%. We also have the 3-year dividend growth rate. We have the times interest earned over the last 12 months. And then we also look at the change in debt growth. And then one of our valuation metrics was price to free cash flow per share. And you can see all those metrics for the 30 stocks passing the favor screen. Let's see, just going down to the bottom section, Charles, of that section, we have price to free cash flow. So we did have a filter requiring a price to free cash flow ratio less than or equal to the average price to free cash flow ratio of the universe of stocks. It's used as a signal, a potentially undervalued stock based on a company's ability to generate cash. And then lastly, if we go down to the last page, we do have a section here that summarizes all the criteria that went into the favor shareholder yield screen. And then just to summarize, it really, the AAII favor approach, it includes a final requirement restricting the results to those companies in the top quintile of net payout yield. So really the favor shareholder yield approach, it has the potential benefit of investing in classic value companies that are also buying back their stock and reducing their debt. So hopefully you enjoy that read. There was also an article from last month's AAII Journal setting up the strategy. We get a little more into the research behind it. So it's really good to maybe read last month's journal as a refresher, and then to actually read this article to see how we actually develop the approach. So again, Charles, I appreciate you allowing me some time during your AMA to go through the strategy.
Thanks for joining us, Derek. This is great. And I want to point out to everybody who's here, Derek's article is currently live on our website. You can access it through our homepage. You can also just do a search for Derek's name in the search box, and you'll find this article and the article that's in the current August issue. We also have a couple other articles from September are currently live on the website. Paul Merriman gives his four asset classes he thinks are best to be held for long-term portfolio growth. They basically are holding the broad market indexes and then also having a value tilt. Craig Israelsen just talk about asset allocation this month as well. What types of asset classes have done well when inflation is rising? What asset classes have done well when inflation is falling? You will notice an asset allocation tone to this issue. Although Derek has the cover article, we do have, as I said, two articles we showed here on asset allocation. You'll see my editor's note. It deals with asset allocation. And we also have what we know as a big question. And the big question is basically a survey we do of a random set of AI members, getting their thoughts about certain investing themes. This month's big question focused on interest rates and what your fellow AA members are doing in response to interest rates with their portfolio. So all very good articles. I encourage you to read them all. As I said, Paul Merriman's, Craig Israelsen's, and Derek's articles are currently live on the website if you want early access to it. We will have the rest of the articles available probably right about the start of the month. So obviously the paper issues ship about the third week of the month, but you do not have to wait on the postman. Delivery times are obviously dependent on the post office. And I know you all have seen the news stories about them. So you can always access the journal right away on AAI.com right at the start of the calendar month. I'm now going to take some questions we received. One of the questions we got actually came from Dick, who asked us about the A+ grades. You might have seen them in our August issue with the ETF guide. You may have seen them in our February issue with our mutual fund guide. They rank funds based on issues such as relative performance, tax cost ratio, expense ratios. And his question was whether or not they're proportionally applied to all the funds. And the answer is they are. So when we publish the guides, or if you go on to AI.com in the mutual fund section, in the ETF section, you'll see those. We do proportionally apply those grades. So when you see an A grade, it means it's a top 20% in the fund, say in terms of performance, or if say you're looking at expense ratios, then obviously you do not want the fund that has the highest 20% expense ratio unless you're really into just giving your money away to the fund company. You want the fund with the lowest expense ratio. And so those we assign to an A grade. So what counts as the best 20% really depends on what you're looking at. So for instance, for stocks, you want a low valuation. So that would be your lowest A+, your A+ grade, your A's. Sorry, that would be your best A+ grade. So that would be your A grades. A stock that, in terms of return, when you're looking at an ETF or a mutual fund, you want those with performance ranking in the top 20% for their category. So that's how we would assign the A grades. And we divide up A through F. It's just like school. So when you see an A grade or a B grade, those are the best funds or the best stocks for a given criteria that grade is measuring. Your Fs are just like in school, they'll get you punished. Those are your stocks that are weak on a certain category, or your funds that are doing poorly on a certain category. Again, you don't want funds with S or expense ratios. That usually means they have a very high expense ratio. I did get a few questions regarding our screens. Rashmi, and I apologize if I mispronounce the name, asked about our screens and why there aren't buy and sell rules with the screens you see on AAII.com. And the reason is because these are screens, and screens are essentially database filters. They take our universe of stocks and they seek to identify which stocks have specific traits. So with the Faber buyback screen, Faber shareholder yield screen that Derek just described, it's going through a universe of exchange traded stocks and looking for the stocks that meet the criteria that's behind the screen. So when you look at our model portfolios, such as our model shadow stock portfolio, that's an actual portfolio. We run the shadow stock portfolio through an actual brokerage. The returns we report are our actual returns from the stocks we've included in the portfolio, from the stocks we've added and deleted, our transaction costs, any mistakes that were made along the way, all those are factored in. For the stock screens on AI.com, those are just the screens. What is the screen finding each month? And we're pretending the stocks are held for 1 month and then removed from the screen, and the screen's completely reconstituted. So the results are really what we're showing there. They're not true portfolio results. But what I love about stock screens is they're a great source of ideas. And they'll often lead you to stocks that meet your criteria, pretty close to having the characteristics you want in a stock without you having to go through 3,000-4,000 stocks to find. They narrow down a list so then you can do your additional research and then apply the rules to doing them. So they're not actual portfolios. Now, there are some screens on AAI.com that you won't find in Stock Investor Pro. And I was asked this question by David. So screens like Dogs of the Dow are screens like Magic Formula, where we have to do certain work outside Stock Investor Pro. For instance, Magic Formula, I just happened to read an updated book by Joel Greenblatt. When I say updated, I think it was updated in 2013, 2014. But I was going through some cleaning around my office and I saw it sitting there and I thought, you know what, I never did read this revised version. And so he talked about essentially doing a triple ranking where you're ranking stocks by ROE, ranking them by, I believe it was valuation, and then resorting the list. So there's certain things with certain screens we can't do a Stock Investor Pro. Basically, we have to run the screen Stock Investor Pro, export it, do some sorting in Excel, and then share the results. So that's why you do not necessarily see them in Stock Investor Pro. I am seeing a few questions coming through regarding allocation, regarding the performance of stocks, regarding bonds in the current environment. I will encourage you to tune in tomorrow night at 7:30. The reason why I say that is I will be focusing on the AAI way, and two parts of it. The first part's actually going to focus on asset allocation. So you'll see this in the September issue of the AAII Journal. We're in the process of revising our asset allocation models. We're taking our moderates and a conservative allocation and making those a little bit more conservative. So you'll see this in the investor graphic in the September issue. Our moderate allocation that you can find on the website, it's currently 70% stocks, 30% bonds. Our conservative allocation is currently 50% stocks, 50% bonds. We're actually reducing the risk of those, so they're now, the moderate's now going to be 60% stocks, 40% bonds, the classic 60-40 mix. The conservative allocation is going to go from 50% stocks, 50% bonds to 40% stocks, 60% bonds. And the idea is to reduce the risk so it's easier from a risk tolerance standpoint to actually follow and adhere to those allocations. I'll go into a lot more detail about the changes we're making and give you some of the logic behind why we're doing that tomorrow night, and I'll have some slides to show you some data. So I'll kindly ask you to tune in tomorrow night. You can register at aai.com/webinars. If for some reason you're unable to make that webinar, we'll have a rebroadcast of it on our website later in the week. I'll also just point out we also have some great webinars coming up in September as well, so you can see the full list onto it. I'll go through some of the other questions that have come through here. Let me just move this over here. Going to go towards the top here. And so we did get one question here actually about whether Derek's screen will be a new screen on AA.com. Right now, we don't have immediate plans to put on a website. We do constantly talk about what screens we provide on the website and other screens we should actually add to it. So we'll definitely take that. I presume it's a request on your part. I will definitely take that into consideration and pass it along. We are always looking at what we're doing to the website, what we can do to enhance it. And we do have various things currently in the works right now. I will tell you in terms of website enhancements. We've done a lot this year, and there is more to come on that realm here. And we'll point out, David asked about finding about the frequency of repurchasing and debt repayments. So if you actually get to our website, you type in the ticker into the search bar, we'll call up our stock evaluator page. You'll see some basic financial information on there. One of the ways you can find out what a company is doing with its stock repurchases is simply look at its cash flow statement. You look at cash from operations, you'll actually see what they're doing in terms of buybacks, in terms of dollar terms. The other thing I do when I'm looking at companies, I'm managing VMQ, is I find it very helpful to read the conference call transcripts. You can find those on sites like Seeking Alpha or even just going to the company's investor relations website. You can just type in the company's name and investor relations. So say you will look at GE, just to throw out a random company. You could type in General Electric investor relations and you'll go to that company's website. You'll then actually find out what the company's plans are in terms of paying down debt, in terms of doing buybacks. What I have noticed anecdotally this spring, a lot of companies postpone their buybacks during the coronavirus. Some companies are starting to reinstate them. Some are still on pause, wanting to get a better sense on what's happening with the pandemic, although they are suggesting they're open to restarting buybacks when they have more confidence about what their short-term outlook looks like. So those are some measures you could actually look at. I'm going to go through some of the screens here, some of the questions here. We do have a question here about valuations, and particularly with the current market environment, and whether or not there's some disconnect. So a few months ago, John Bukowski in his shadow stock updates, and I will say there is actually a shadow stock update in the September issue, but a couple of months ago, early this year, John Bukowski wrote about the price to book ratio in his shadow stock model shadow stock portfolio update. I want to say it was in our April issue. You can actually, if you go to the journal section, you click on index, you can actually see all the articles we published this year where you looked at the price to book ratio, basically looking at the differences between growth and value. And right now we're seeing a huge variance where growth basically is relative to value and where large is relative to small. So we are seeing that disconnect. We're also in a period right now where we've seen value investing underperform. I'm going to just slip in a plug here for our webinar next week on September 2nd with Larry Swedroe. And the reason I'm doing it is Larry actually writes about in his new book, The Incredible Shrinking Alpha. And what we're seeing here is we've seen, one thing he says with value, we have gone through a period of underperformance for value. So those of you following the shadow stock portfolio performance, you know the model portfolio has not been doing so well over the past few years. Value itself has been out of favor. But when we look at the band of where growth is to value, it's gotten really wide. And when you're following specific strategies, such as a shadow stock, part of the reason those strategies work so well over the long term is that you do have these short-term risks where they do underperform, these shorter-term periods where they lag the market. And if you're a professional money manager, you're getting judged on your performance most often on periods of 3 years. If you're lucky, maybe 5 years. And so you're under this constant pressure to outperform. And so what you see on the professional level is these people know what works over the long term. They also know what they have to do to not get fired. So, excuse me, I'm hitting my microphone here. So what you see here is you have these periods of time where some strategies like value will incur periods of underperformance, and strategies like the shadow stock where it's microcap value will underperform. And yes, it's nail biting. Yes, it's a little bit, makes you want to crunch a little bit, but because you have these periods of underperformance, it makes it harder for people to stick with a strategy. And because it can be harder to stick with a strategy, it leads to longer term outperformance because occasionally that band between growth and value gets stretched too much and it snaps back. And when it snaps back, you see value outperform by a large amount. And those investors who understand that value works over the long term get rewarded for doing so. So I'm just watching the clock here, the time here. Let me go through real quick and see if there's any journal related questions I've missed here real quick. I'm just going to scroll through here really quickly. So I'm getting here a question real quick about the list of the favor stocks. So the stocks passing Derek's favor screen are actually listed on his article. As I said, the article's online right now, so you could actually see it right there on the website. You can see all the stocks passing the screen from it. We are getting a couple questions about Platinum coming in. We did launch a new Platinum service. This gives you access to not only shadow stock, but also, which is including your membership, but also gives you access to dividend investing, which Derek runs, VMQ, which I oversee, Stock Superstars, which Wayne Thorpe manages that portfolio. He's a lead manager on it. They're A+ investing service. We did a webinar on that last week. It's on, you can go to AI.com webinars and see that. Those of you who are subscribing to a premium service, contact member services. We are sending you out special emails for those as well regarding the pricing of that. That looks like what we'll have as far as most of the journal questions we have here. So we did, I'll say, so one last question here. I was watching the time here. So, you know, we're getting questions about buying and selling and when to identify stocks to sell. One of the things I'll point you to is take a look at the model shadow stock portfolio. We do get questions occasionally, how do I know when it's time to sell stocks? And I think the model shadow stock portfolio is a really good example to look at, and you'll see the rules again in the September issue. And the reason why I say that, if you look at the rules for a shadow stock portfolio, our sell rules are really the opposite of our buy rules. So our buy rules are, we want to buy stocks when they're very low in value, when they're very small in size, and we also want them to be profitable. Our sell rules are when they're no longer microcap stocks, when their valuation, when they're no longer deep value, still pretty cheaply valuable, they're no longer deep valued, or when they stop becoming profitable. And the reason why I say it's a good basis to think about your rules is you may not follow the rules that the shadow stock uses, but if you have reasons for buying, then your reasons for selling should be the opposite. So if you're a value investor, stock's no longer a value, maybe it's expensive, that would be a reason for selling. If you're a growth investor and you bought a stock, say it passed one of our growth screens, and you notice now that growth has really slowed, perhaps it's reversed, that would be a reason for selling. And so in an AI way, I'm actually talking next week, I'll start talking about stocks and about how you view stocks. But I want you to think about why you're buying it and take the opposite of those. And those are your sell rules and writing those down. And I realize that sounds really simple, but simple strategies are extremely effective when it comes to investing. And part of the reason our shadow stock portfolio has worked so well over the long term is not only the type of strategy it follows, but it's also because over the years, Jim Clunan and now John Bukowski have just followed those rules, follow that systematic approach to investing. So we're a little past 2:30 on the time here. You can always reach me at charles@aai.com if you have any questions. Again, for those of you having questions about asset allocation, I encourage you to tune in tomorrow night, 7:30 Central Time. We'll be talking more about the AI way and more about the investor graphic, actually, you'll be seeing in the September issue. Thanks again for attending. Thank you for Derek for the great presentation on the Faber strategy, and I wish you all prosperity and good health.